Hey guys, you're back with Steph Den, and today we're breaking down the RRSP for our Canadian viewers. This is basically a follow-up to our TFSA video, and if you haven't checked that one out yet, we recommend that you check it out before this one. We give a really great breakdown and solid foundation. So the Registered Retirement Savings Plan, or an RRSP, is a retirement account that's been around since the late 50s here in Canada, and it's pretty similar to a 401k in the States. It was introduced by the government to help Canadians save for retirement, and like we mentioned before in our TFSA video, it can be hard to get straight what all these different terms are that revolve around these different investment accounts. So today we're going to cover what an RRSP is, its benefits, and how it all works. So if you're excited for this video, give us a like down below and let's get started. Okay, so what is an RRSP? Basically, it's a tax-sheltered account, meaning that the government actually created them as a way to motivate people to start to save money for their retirement. So I mentioned it being a tax-sheltered account. What does that part really mean? It means that the government cannot charge you any taxes on the money or investments that you have held in that account. So picture it like an umbrella. Your RRSP is the umbrella, the rain coming down is the government or your taxes, and it's being blocked by that RRSP. Now, similar to what we mentioned in our TFSA video, the RRSP might be a little bit confusing because it has the word savings in its name. However, like the TFSA, you do have to remember that the RRSP is an investment account, meaning that you buy and hold investments within that account. To give you another example, think of the RRSP as something similar to a laundry basket, and we did use this analogy before in our past video. The laundry basket by itself has nothing in it and it weighs nothing. However, throughout the week, as you wear more clothes, or in this case, make more money, you'll probably start throwing those clothes into that basket. In this case, those clothes would be your investments, whether that's stocks, bonds, ETFs, REITs, cash, you name it.
Now, before we move on and explain how it actually works, let's address a few things because we've gotten quite a few questions regarding the RRSP. And the reason we're getting all these questions is because it's one of those accounts that's constantly mentioned, but really misunderstood. All right, so first off, something that I read recently in our comments and something that I've been hearing for a while is that an RRSP is great if you want to defer your taxes. But what exactly does that mean? You know, when you hear that right off the bat, you're like, okay, cool, so I guess I don't have to pay taxes, but what exactly does that mean? To break things down, unlike the TFSA, when you make contributions, so either by putting cash or by buying investments within the account, the amount that you've now put into that account or invested is deductible from your taxable income. So basically this means that it can help you pay less taxes at the end of the year, or to put it in a different way, around tax time when everyone's scrambling to find out whether they're getting a refund or whether they actually owe taxes to the government. It could help you either increase that refund or it could help you decrease the amount that you owe to the government. Now I know I just briefly touched on taxes, which obviously isn't an easy topic to go over, but we have touched on it in one of my debt-free journey videos. So if you haven't seen that video, make sure you check it out for a little bit more context, but we will be coming out with a taxes breakdown video to show you that it's not as hard as the accountants and the people that are making money off of you want to make it seem. So now if we bring it back to RRSPs, another comment or another question that we've seen a lot is, how do I buy an RRSP? Now, similar to when we were addressing what a TFSA is, there's obviously a few errors in that question. So an RRSP is not something you can buy. It's an account that you can open up and invest in. And you can do this either through your bank, you can do it through investing platforms like Questrade, Wealthsimple. You can even do it through your work if you have a defined contribution plan, if you have some sort of retirement pension plan. All of these are options that are available to you if you want to start thinking about investing into your retirement. So I know I mentioned being able to open an account through your bank, through Questrade, Wealthsimple, whatever. Similar to the TFSA, there is no maximum number of accounts that you can actually open up. This means that you can have an RRSP with your bank, you can have an RRSP with your work, you can have an RRSP with Wealthsimple. You can have as many RRSPs as you want. So like I said, and similar to the TFSA, although you can have all these different accounts open in different places, the total value of all these accounts, if you were to add them up, cannot exceed your contribution limit. And you'll notice this is exactly similar to the TFSA. So for anyone who's looking at their screens right now, still really confused, remember, we're just getting started and we're about to bring the basics. Obviously, these are topics that no one ever wants to talk about because they don't want you to understand these things. You know, if we take taxes, for example, I knew nothing about taxes up until being in university, and given the fact that I have an accounting background, I had to take a tax course. But what I will tell you is that none of this is as hard as anyone will make it out to be, and we're gonna break it down if you stick with us throughout the video.
Now let's dive into how it works. And like we mentioned before, the RRSP is tax sheltered, meaning that any income that you earn within it will be tax-free and the government can't touch it. This includes dividends, interest, and capital gain. For anyone who doesn't know what capital gains are, I'm gonna give you an example. Let's say you invested $1,000 into a stock like Tesla, and then eventually over time that $1,000 grew into $5,000. The difference there, that $4,000 difference between 1,000 and 5,000 would be your capital gain. So basically, as long as your money is within your RRSP, you won't be taxed on that initial investment and you won't be taxed on the amount that you gain over time as well. So who can actually open up an account? Well, as long as you're living in Canada, you're earning a Canadian income, and you filed at least one tax return, you're eligible to open up an RRSP. So what's interesting about this account is that unlike a TFSA, there's no minimum age requirement, but there is a maximum age. So for the TFSA, there's a minimum age requirement of 18 years old, and for an RRSP, there's a maximum age where you can still contribute, which is 71 years old. Overall, once you've filed that first tax return, meaning that you've had that year's worth of income coming in, you can start building your contribution room from that point onwards. And like I just insinuated, your contribution room is from your income from previous years as well. So let's say you're new to the country and you have that job locked down, you still can't open up an RRSP until you've actually worked for a little bit of time, had that income coming in, and have filed that tax return. Okay, so let's dive into the numbers. Basically, every year your contribution room increases by 18% of your last year's pre-tax income. So let's say that you make $50,000 in 2019. That means that the contribution room that you've gained going into 2020 is $9,000, or 18% of that $50,000. However, something that you should keep in mind is that there is a limit, and it's funny because whenever something seems too good to be true, there's always something that comes up and kind of blocks it. So if you're like me, you're probably thinking, wow, if and when I start to make more money, 18% per year could be a lot. But of course, that's why the maximum is there. So we're gonna throw a chart up on the screen somewhere showing you what the maximum has been for each year in the past, but let's look at 2019 for an example. That year, the maximum amount that you could contribute, regardless of what your income was $26,500. If we look at 2020, the maximum is now around $27,000. So let's look at an example. If your income in 2020 was $200,000, 18% of that is $36,000, but $36,000 would not be your limit. You would be stuck with that maximum of around $27,000 of contribution room.
So in case you're wondering why they put a limit on the amount that a person can contribute, well, it's because your contributions reduce the amount of income tax a person has to pay each year. So basically the CRA, or the Canada Revenue Agency, sets a limit each year on how much a person can contribute to make sure that there aren't any excess contributions. So when we talk about your contribution room increasing by 18% of your previous year's income, what income do they actually factor into this calculation? Well, for one, they look at your pre-tax employment income. So for me, I'm a consultant, let's say I make 70K a year. They'll factor that 70K, not what I actually make after taxes and everything, but they'll factor that 70K because it is my pre-tax employment income. And number two, they'll look at your net business income. So let's say, for example, I own an apparel company, a clothing company that sells clothing online. What they'll do is they'll look at my income minus my expenses from that business, and they'll add that in their calculation of my 18% of my previous year's income. Number three, they'll also look at your net rental income. So let's say you own a duplex or you rent out your basement, they're gonna factor that in as well. And the last one, or number four, is gonna be your disability income. So anyone who earns disability income either from the government or wherever you get it from, they're gonna be factoring that in into the calculation as well. Something that they don't factor in, you have to keep this in mind, is any investment income. So anything that you earn from your investments, they're not gonna consider that in that 18% previous year's income calculation. All right, so moving on, something that you need to remember, and just like the TFSA, if you have any unused contribution room, that can be carried on into the future. So to give you a quick example, let's say you didn't invest at all this year. That $27,230 limit that Steph mentioned earlier for 2020, as well as any previous contribution limits or room that you hadn't used in the past, that can be brought either to the next year or carried forward with you. Once again, for your RRSP, if you wanna know what your contribution room is, you can find it on your notice of assessment. So for those of you who get it by mail after tax time each year, or for anyone who gets it online, you can find it on that notice of assessment. So if I wanna know what my contribution limit is, I'll usually log into the CRA's online portal. I think they call it My Account. So here you can find your notice of assessment, and then you can also find that contribution limit listed on that notice of assessment online. Now overall, something that I do wanna stress is that your money and your investments will remain tax-free so long as they're in an RRSP. But you have to keep in mind that once you do start withdrawing, or you do withdraw withdraw, you will be taxed. And obviously this is one of the main differences between an RRSP and a TFSA. If you were to withdraw your investments or your cash out of a TFSA, you're not going to be taxed. And so this kind of leads me into one of the main reasons as to why you wouldn't necessarily want to hold cash in this account. In order for you to maximize the full potential of your RRSP, you should be purchasing investments in that account as opposed to holding cash. Now, for anyone who's worried about inflation or in general the value of their money decreasing over time, we've obviously talked about high interest rate savings accounts in the past. Steph and I are obviously huge proponents of utilizing high interest rate savings accounts, especially if you're looking to either gain a little bit on inflation or at the bare minimum match inflation so that the value of your money isn't decreasing over time. We've done a couple videos in the past breaking down these types of accounts. For anyone who hasn't checked out those videos, after reviewing a bunch of different banks, we decided to hold some of our money within EQ Bank's high interest rate savings account. And if you want to learn more about that particular bank, I highly recommend you check out those videos, or we have a link down below, so make sure you check that out as well. So now that we've broken down what an RRSP is, how it all works, we have to talk about some of the benefits. Something that me and Steph talked about in our how to invest that first paycheck video. By the way, if you haven't checked out that one, make sure you check it out after this one. But anyway, something that we talked about in that video were pension plans and employer match programs. Like we've said before, these are amazing and you should definitely sign up if you have the opportunity to do so. Something that is important to understand, because at your work, you're not necessarily opening up an RRSP. You usually just sign up and then they start taking money out of your paycheck. But what you do need to understand with these programs is that the money that you invest along with the money that is matched by your employer, that all counts towards your contribution room and limit within your RRSP. So although your program might be called a defined contribution plan, those amounts that are going in there are still going towards your RRSP. So something that's offered to Canadians and is a great benefit is the home buyers plan. So this whole time we've obviously been talking about how RRSPs can be great. So one of the caveats and one of the main differences between an RRSP and a TFSA is that when you do take out money, you're taxed. However, there is an exception to this rule. So through an RRSP, if you or your spouse wants to buy a home, as long as you haven't owned a home in the last 5 years, you can actually borrow money from yourself through your RRSP without there being any sort of tax. So you're allowed to do this as long as you pay yourself back or put that money back into your RRSP within 15 years of you taking it out. So this is obviously something that's really cool and offers a lot of incentive to families or home buyers in general. Third great benefit is the lifelong learning plan. So similar to the home buyers plan, this lets you borrow money once again from yourself, but this time you can use that money for the education of either yourself or for your spouse. It can't be used for your kids, but it can be used either for yourself or your spouse. So this plan lets you borrow up to $10,000 a year for every 4-year period. Remember, they won't tax you like they normally would if you weren't utilizing one of these plans. So once again, you can borrow this money as long as you pay it back within a 10-year window. So the last benefit and something that's investment focused, you can actually do this in an RRSP, but you can't in a TFSA, is invest in US dividends or US ETFs without incurring a withholding tax. So for example, if you were to buy stocks in your TFSA of US companies that paid out dividends, then the US government would keep 15% of any dividend that's paid out to you if you are a Canadian resident receiving a dividend from a United States company. However, if you were to buy them in your RRSP, then you would be good to go. And the reason you'd be good to go is because the US and Canada have a tax treaty when it comes to retirement accounts. So since we're still on the topic, something else that you should keep in mind is that if you're Canadian and you're buying these stocks within your TFSA, it's actually really easy to miss the 15% withholding tax on these dividends or these ETFs, given the fact that the US government takes that 15% before the dividend actually hits your account. So you should definitely keep that in mind.
Okay, now before we wrap up, we did want to give you some pieces that you should look further into. One of those things is that you're actually charged a 1% fee per month on the excess amount that you go over your contribution limit if you were to do so. This is why you definitely have to keep track of your RRSP contributions, but you should also know that the government does give you about a $2,000 grace amount. So let's just say that your contribution limit was $5,000. If you were to contribute $7,000, that would still be okay. But if you were to go up to $8,000, that $1,000 over the grace amount, that would start to be charged a 1% fee per month. We also wanted to share more context on the topic of deferring taxes today until you retire, and actually dive into what that really means. Basically, you can utilize an RRSP deduction that's available to you around tax time that allows you to decrease the amount of taxes that you owe based on your last year, or potentially increase your tax refund. To give you a really simple example, let's say that your income was $50,000, and throughout that last year, you contributed about $10,000 into your RRSP. RRSP. Essentially what you can do is decrease your taxable income to $40,000 for the year, but keep in mind that by doing that and contributing that $10,000 to your RRSP, you will still need to pay taxes in the future when you're taking money out of the RRSP. Basically, to explain that a little bit further, once you retire, you won't be making as much income as you were before you retired, which means that you'll be in a lower tax bracket. It means that in the future, you will still have to pay taxes on the amount if you're contributing to your RRSP today and utilizing those deductions. However, because in the future, you'll likely be in that lower tax bracket, you'll be paying less taxes then than you would be now, or at least that's the ideal scenario. So like I just mentioned, throughout the years that you're contributing to your RRSP, your investments are growing tax-free, but eventually when you do try and take that money out, it will be taxed just as regular income would be. However, one caveat to this is withholding taxes. So basically you're charged withholding taxes from whichever bank or financial institution that you're holding your account at. And when you do take money out of your RRSP, as soon as it's taken out, you're charged with that withholding tax. So again, whatever time of year it is, whether it's tax season or not, when you take money out of that RRSP account, you will be charged with the withholding taxes. And some people see this as a penalty, but really it's just an insurance for them that they get that money up front. And then if you did pay too much or if anything strange is going on with that, you'll get that money back in a tax refund when tax season comes around. Another thing to note there is that if the opposite happens and you pay too little, you'll also have to owe that back in taxes when you file your taxes for that year. Now, the last thing that we want to note, and this is an important one, is that when you do withdraw from your RRSP, you do forever lose that contribution room that you used up to make that original deposit. You definitely can continue making your maximum yearly contribution amounts in the future, but you can never recontribute that amount that you lost when you withdrew some money from your RRSP. So really keep this one in mind because it does potentially reduce the value of your RRSP once you finally hit that retirement stage.
Alright guys, we hope that you enjoyed this video. We know that it was jam-packed. We know that there was a lot of stuff going around. So if you guys have any questions, make sure you let us know down below. We know that the RRSP is a little bit different from the TFSA. Once again, if you haven't checked out that video or if you haven't checked out our investment, saving, and debt videos, make sure you check them out next door. But once again, if you guys have any questions, let us know down below. And we will be back next week, same time, same place. You already know the deal. Let's go.